up the mortgage mum, having become a mortgage broker because I wanted to have a flexible career around my children. But I have a brain somewhere in here, and I wanted to use it still, even though I really wanted to be there to pick up my kids from school run and just be present at home rather than in London at the time, commuting a lot of the time. When I set it up, I realised there wasn't many women in the industry. There certainly wasn't any women doing it the way I wanted to, flexibly. And so my idea for the Mortgage Mum was born, where I felt there were more women like me who could help more people like you, really demystify the mortgage process, make it friendly, so you don't have to sit for 3 hours on the phone to a bank or in a suited conversation, that this can feel really, really relaxed. And the more relaxed people are when they're getting financial advice and talking about money, the more their brains can digest and process. And the more you learn, the more empowered you get. That's really where the passion is born. The voice obviously features so heavily in my journey because I didn't have the confidence necessarily to start a business, to talk openly about my goals and ambitions, and to sing on a stage. But I found the confidence through self-development and the support of other women. And it was a life-changing event for me because I then set up the Mortgage Mum, and obviously I got to go on The Voice and meet Jennifer Hudson and, you know, be on TV for the first time, which was a thrill for me and my kids who were watching at the time. But yeah, I'm here today to help you demystify anything you want to know in the mortgage space. And hopefully if you get one golden nugget from today, then we'll have done a brilliant job. So thanks.
Yes. Oh, thank you, Sarah. And I think one of the things I love about your journey is, you know how women are usually boxed in and they expect that if you're a singer, you can't do business or you can't do other stuff. Yes. And just to see a mom, because being a mom is by far the hardest job I've had. Yes. But a mom that can sing and go and tell you to do it and can have a business that's amazing and so helpful is such an inspiration. And I think we need so many more role models that like this. And for you to be able to, you know, share your experiences and what your journey has been is just so cool. So maximum respect and hats off for that. I'm so happy.
Yeah, and so I think, but we'll get into it. But thank you so much. I think that the key thing I always want to get across is I was not born this ambitious. My children gave me my ambition.
Yes.
And once I birthed a baby into the world, I sort of felt like, you know what? I am normal and I actually can do hard things, because that was hard, but the most amazing things come out of it. Yeah. And now that's the mindset I have. I do hard things a lot and they lead to really great things happening. So that's kind of the new personality that I wish I'd had in my 20s.
Yeah.
I had to wait till I was a mum to get it. So yeah.
I agree. Like, I just remember when we're going through, I went through a period, I've written a book and it's coming out in the 1st of October. But I remember one of my biggest fears when we're going through like financial vulnerability was like, oh my gosh, I don't want my children to be poor. Like, I need to sort this out. I don't want them to not have a roof over their heads, you know? And that drove me so much. I didn't have time to break. I had to just go, you know? Which was really cool. But yeah, I hear you totally.
Yeah, that's amazing.
That's been a good starting point. And I hope everyone understands that we are trying to be as down to earth as possible. We are both moms. We understand the struggles that women go through. And over and beyond that, we understand ambition and aspiration. I think the first thing we'll do is we're going to cut this up in different ways for people who are looking to get on the property ladder or who are first-time buyers, and you know what things they need to navigate. I certainly had to navigate so much. I wish you had been there in my day when we were getting our first property. And then we'll also look at maybe people who are already on the property ladder and how they can optimize that. And then my favorite one is property investment. Any tips or tricks you can get there. People just keep putting your questions in the chat. I've seen a few coming through from the team. I will make sure that we just jump in and you know, answer them as we go. Sure. One thing that I wanted us to look at was from a first buyer point of view, right? Mm-hmm. I think, Sarah, for me, I just remember, first of all, I had no clue what I was doing. I was born and bred in Uganda, where you need to have cash to go and buy stuff. So first of all, I was very biased to debt, and a mortgage to me was debt. So I was just like, I don't want to be borrowing. I need to have money to buy a house. But then the prices were so out of reach. And so we're like, yeah, we need to get this thing called a mortgage. Had no clue what I was doing, went into the bank and had no idea what questions to ask. It was so daunting. And the only thing I remember thinking about was we need a deposit. But then I later found out there's more than just the deposit, right? So could you talk us through a bit of those things? Because every time you're like planning for a property, I feel like the first thing you do is think about the deposit, what deposit do I need? But what other things on the peripherals of that should you be doing to prepare for your first property?
Yeah, great question. It's so interesting as well, sort of the concept of buying homes in cash. Can you imagine what it would be like to do that? I mean, it would just be a nightmare, even more so.
I would still not be on the property ladder if I was still waiting.
I don't think any of us would be. I think it's really important to remember the market that we're in at the moment has changed. You know, I sort of spent time thinking about when I bought my first property, and I had 100% mortgage, and I didn't have to save a deposit, and I'd got interest only. I worked for a mortgage company, so I got proper advice, and I had a really long-term interest only on a tracker rate. And of course, the property market crashed. It was 2008. So the property market crashed and 100% mortgages got taken off the market. So there's a whole generation of us who got on the property ladder, and a lot of us work in the mortgage market with 100% mortgages. So firstly, I recognise how hard it is for people to save a deposit, and that used to look like 10%, but now we are seeing the return of 100% mortgages, and the government have guaranteed the mortgage guarantee scheme, which means 5% deposit is considered to be a good space to aim for, if you like. So you've got a few things that I would advise you to do if you're looking to get on the ladder. One is sort of deep money work, you know, looking at your monthly budgeting, looking at how much you spend on things. These are things that people tend to do later when they're about to buy, and then they look at how much bills they have left, and then they change their behaviours. But our money behaviour starts from when we're 7 years old, and a lot of it is very unconscious until we actually have to do something as big as buying a property, and all of a sudden we realise that, you know, we have some sort of relationship with money, positive or negative. So it's really healthy to start looking at your relationship with money and your habits monthly with money now, before you're sort of starting to look, because you really will then understand, for me to have this lifestyle that I'm living in now, that I'm used to, this is how much I spend on this, and this is what I feel I could afford for a mortgage payment.
Sarah, just to cut in there, you've talked about, I'm just picking up on one of the questions about the
question. Should I be able to see them? Because I can't see.
No, the team have to filter them in, otherwise we'll get so distracted.
I can't see questions. Okay.
Yeah. Someone is asking about the first-time buyer scheme that you talked about, the government scheme. Could you explain a bit about what that is? And then I have another question of my own.
Yeah, of course. So I'll skip back a step. So the mortgage guarantee scheme is essentially a guarantee from the government to the lenders. It kind of is all happening in the background. So as far as you're concerned, there are 95% mortgages out there. So you can get a mortgage with a 5% deposit from the banks that are working in the background with the government. Try not to get too technical. What it basically means is lenders, banks are happy to take more risk at letting you have a property with a lower deposit of 5%, because the government will guarantee them in the background that if you don't pay your mortgage, and so happen that there tends to be an amount of people that don't do it, they will guarantee the bank the loss that they would make on that. So essentially, it just means that they're more likely to give you 95% mortgages. So it's just the government trying to prop that part of the market up. I don't want to overcomplicate it. It's not a specific type of mortgage. It's just when you see a lender offering a 95% loan to value mortgage, it's probably that they're linked to the mortgage guarantee scheme in the background, which is allowing them to offer that to you. I will also touch a bit more on the 100% mortgage, because that is really popular at the moment. And
I didn't even know that was back, Sarah. That's really exciting.
It is back. It is back.
Wow.
So 8 mortgages, they are very big Dutch lender, and they're quite new to the UK market. What they have introduced is a true 100% mortgage with a minimum income of £24,000 a year. The difference with this mortgage compared to the usual mortgages that we see in the UK is instead of having a 2-year fixed rate or a 5-year fixed rate, which is the period in which you typically will secure your rate for, they are doing a 10-year or a 15-year fixed rate. However, if you do want to move home, normally you would pay a fixed rate penalty. This is where it gets so complicated, so I have to try and sort of not go too far ahead. There's no early repayment charges basically on this. So they really recognise that they're tying you in for 10 or 15 years, but they're not expecting you to stay in that property for that long. If you do decide to move, you can pay that mortgage back and you don't have to pay a penalty to do it. So you've got the best of both worlds. But it is a brand new concept for people to have 100% mortgage in this generation, but also to have a longer term fixed rate. And the rates are typically higher than you would get putting 5% down as a deposit or 10% down as a deposit. What I really want to talk about for those of you who might be listening to me now and saying, well, you know, this is all well and good, but I don't really want to pay a higher rate on 100%. I want to save for a deposit. But how can I do that? You know, 5% is quite a lot to save, and I'm renting at the moment. There are products, and we are working directly with the FCA, who are working directly with the banks to try and help those of you who are renting, who can absolutely afford a monthly mortgage payment equivalent to your rent. But the way the mortgage market works with affordability is often those people can't get the mortgage that they can afford monthly. They can prove it. We can see history, we can prove they've been renting for a long time and have never missed a rent payment, but yet their mortgage payment's going to be less, and we have to say no. It seems absolutely crazy. So there's lots that the FCA are doing in the background that's coming very soon, which will mean that your rent will not just be considered as affordability, but for some lenders it will stop them needing a deposit from you as well, because a long-term security. There's already one lender doing it, which is Skipton Building Society. They're very passionate about first-time buyers. They just want to help first-time buyers get on the market, and they are doing something called a track record mortgage. And if you've been renting for 12 of the last 18 months, you can apply for a mortgage and you don't need the deposit. The deposit's wrapped up into that rent. So it's well worth, no matter what else I say in this, please speak to an advisor as soon as you're thinking about buying a property, even if it's 5-year plan away, even if it's on your vision board. There's no way you're going to know all of in just what I've said in 5 minutes. That would take you a long time to find out in the market, and the market's moving quickly in the background because we're lobbying for change. You'll see the press yesterday, the government are putting pressure on the FCA to make it better for banks, to make it easier for first-time buyers. So this is the perfect day to do this webinar. There's so much happening and it's moving very, very quickly. So I would just say to you, if you're somebody that's thinking, or you're saving for a deposit, or you're thinking about buying your first house or your first place, speak to somebody and have that contact point that if things change in the market, we can let you know, but you also know, what would I need to earn? How is it calculated? What sort of things do I need to know? And you can learn from that advisor before you need them. That's what they're there for, because right now, it won't always be this way, I'll make sure of it, but right now there isn't a go-to place for you to find out everything you need to know and to prepare yourself and to start, like I said, mapping out your monthly budgets and saving your money. You might be saving towards a deposit you don't even need to get on the or you might, having looked at the scenarios, this is what it looks like if you don't have a deposit. Actually, if you can save 5% or 10, this is what it will look like. You get to choose. You're empowered to make the choice, rather than, you know, just squirreling away and not really knowing what you're doing it for and what the overall goal is and how far away you are from it.
That is so cool
about this. So just ask me more specific questions to make sure I get everything you need across. But yeah, going back to your original question, which was how do people prepare? Looking at your monthly budgets first. Where can you get better? You know, for me, I'm tracking this every single month. I'm writing down every single thing I spend, putting them into categories. And honestly, it is crazy how quickly things things go up in price value, such as food shopping, but also how much you spend without knowing you're spending it. For me, Prime is something I this month I need to watch, because it's too easy to buy things on Prime, and you're not always getting the best value item on Amazon, but it's convenient. So it's just watching your behaviors and going, actually, that's a lot of money I spend on that a month. Did I need to spend all of that this month? And if I moved into a property and I need an extra £300 a month, say, can I find that in my natural habits, or am I going to have to go without certain things in my life to make it happen? And if so, am I willing to give up those things? And it's much more empowered to do that when you don't have to and you're working towards something, than it is to do it when you're in the moment. You know, when you've secured a property and all of a sudden you're living in it and you're recognizing this in the moment. So I really, really encourage that to happen. And from there, I mean, it's something we'll do with you anyway. We don't just ask you what you earn. We ask you what you spend your money on every month. So if you can come to me with your lovely spreadsheet or, you know, your notepad, and you know what you spend, that's going to make our job so much easier to give you the best advice, because we want to make sure you have a lovely lifestyle in the home that you're living in as well, and that you can aspire to have all your goals met in the future as well. So I would really encourage it. And if you need tools to help you, there are lots of tools out there, and journals, and it depends what you're into. I love a journal, but you know, they're very pretty. This is my finance journal, and you can make it a positive exercise if that's what you're into. But for some people, they're like, no, just tell me how much to save a month.
I totally agree, though, on the budgeting bit. But I think one of my most exciting experiences that actually made me enjoy budgeting, because I hated budgeting. I felt like budgeting was a noose around my neck. I couldn't live my life. But when we determined that we're going to buy a property, and we, you know, at the time we had to have a deposit, I think it was post 2008, of course, so they had taken away the 100% mortgage. Yeah. And I think because of the nature of our income or something, we had to come up with 10%, or that's the number that we thought we needed. Yeah. And the time, so we knew what the number was, and we're working towards that. And Sarah, I've never enjoyed budgeting more. I was happy not to spend on Prime. I was happy not to have the takeaway, happy not to go out, because I was like, every penny I'm saving is going towards my first home. So it was so cool. And by the time we got the property, my habits were fine.
Yes, that's amazing. That is the perfect journey to home ownership. You got the goal, you got the advice, you worked towards it, you felt empowered, and you take that with you.
Yeah, and it's so liberating. It literally is. Yeah. So we have the results back from the poll. We have 47% are first-time home buyers, 20% are homeowners, and investors are 33%. So exciting. And then we have a really good question. Thank you for asking this. I will not name your name because you've sent it in the private chat, and you know, we really recognize this. But someone is saying, hi, good afternoon. I would like to buy my first home, but my credit score is bad. How or what else can I do to start investing towards it, or am I gone, basically?
Okay, so you're not gone at all. There are specialist lenders out there that are very, very passionate. So people such as Pepper Money, who are very passionate about people that have got bad credit, basically, and made mistakes. Now, bad credit means something different to every person and every lender. There's almost always a reason it happened, and it's our job to find out what that reason is, to see if it's a pattern of behaviour or an incident or a lesson that you've had to learn. And lenders go in with the same approach. You will pay more on your rate if you've got credit to consider from a lender's perspective, especially if we can't place this on the mortgage market and on what we call the high street market, which are your best mortgage rates. However, it doesn't mean you can't get on the property ladder. It just means you're probably going to pay a bit more each month than you would have done if you didn't have the debt. But the idea of these lenders, such as Pepper Money, is that we are placing you with them for a period of time, and we're working with you to work with your credit report to go, right, we're going to do this for 2 years. And in 2 years' time, this lender will take you on because this piece of your bad credit report will have gone away. I guess my big question for you would be, are you in a different position now and you're just carrying the weight of what happened before? Or are you still in a position where that credit behavior is continuing? I come back to what I said about the relationship with money, and really getting to the root of what happened is really important for you to deal with it without any shame. And it might be that you need kind of a safe place to do that. But I want to normalize, this was not taught to us all at school. Dealing with credit, managing money alongside our emotions and our life is something you were only ever exposed to as a child, not from an educational setting. And so forgiving yourself for those difficult money behaviors is really important in order for you to move forward, and recognizing that you only knew what you knew at the time, but there is a lot more information available to you now. Please talk to an advisor one-to-one, because they're not going to look at you differently or treat you differently because you have bad credit. And there's people like us who are really excited to help turn your story around. And we love that when we see that happen. If you speak to an advisor and they make you feel judged or some shame, speak to a new one. There are thousands of advisors in the country. Find the right one for you. You will feel that connection. And if you don't, change it. But please don't think you are written off. You can get on the ladder with bad credit. You can get mortgages with bad credit. Or at the very least, if you is in a position where we can't help you, we will help you make a plan so that you will know, I can't do this, but if I don't have any more bad credit for the next year, I can apply it in a year, and then I will be able to look at these options. Or if I pay this IVA off or this debt management plan off, then I might be in a better position in 2 years. We will be able to tell you that. So you won't just go away blind. With the right advisor, you should have a bit of a plan in place, even if the answer right now is no. There should be no room for it just to be, bank says no, see you later, unlucky, good luck, I hope you get on okay. If that's what you're getting, that shouldn't be the case anymore. As an industry, we need to do better. So please make sure you find the right people to speak to if that happens.
That's such a good response. And I agree. I've written a book, which I said is launching in October. And one of the things I share is my shame when we were financially vulnerable. I felt so ashamed of just having squandered so much money, because, we moved here with a lot of money. We had good jobs and, a small rock in the boat, and everything just fell apart. And I didn't reach out for help for a very, very long time, 2 years to be precise. I didn't reach out for help. We didn't reach out for help. I was so ashamed. I was crying myself to sleep every night. And guess what? When I did reach out for help, eventually there was so much help on offer. My family were willing to step in. Everyone was willing to step in. Everyone had good guidance on where I should go for resources to bring myself back to scratch. It was, I just wondered why I hadn't reached out much sooner. So I really understand your anxiety, especially since you've posted the question in the private, side, and I totally get that. But there is nothing to be ashamed of. You're not the first person. You won't be the last. I've dealt with clients who have had repossessions and they're trying to start again. And that also is not something to be ashamed about. You fail to make your payments, something happens in life. And as Sarah says, and as an industry, financial services really should be obliged to help us to get better, to do better with our assets and liabilities. So it's not on you at all. I think that's an important thing. So thank you for that, Sarah.
Thank you. Your story is so inspiring. It's amazing.
So I have this one's probably a plug-in for you, but the reason I'm asking this is I really like your approach, and as we've already established, you're a bit of me. But I think it's important on this call because another thing that I struggled with certainly was finding the right advisor, right? It's like there's so many people out there. I didn't even know there were mortgage advisors. So whenever we first went out, we were going out to banks who I have to say are typically more expensive, and they're looking at their own products. We didn't understand the market at all. We're just new to everything. But maybe just to be direct, and I'm not meaning this as a plug, it is going to be a plug because I think women need to understand how best they can approach finding the right people for mortgages. So why should women or anyone on this call today come to the Mortgage Mom rather than any high street mortgage broker? And how do you support women or your clients better?
Okay, well, it is a shameless plug, but I will go with it. And I will also be very, very fair to other advisors as well, that generally in the world of what we do, 90% of the business that is submitted to the UK banks comes from us as advisors.
Mm-hmm.
So the banks are motivated to work with us. And the reason why is because they can't give clients the level of support, therapy, compassion, empathy, and wraparound that they know that we can. They can give them factual advice, but they are overstretched. And in all fairness, the mortgage market needs much more than that, and people deserve much more than that when it comes to advice. Now, any advisor, I believe, should be going over and above to support and handhold you through the process. Part of the success of the Mortgage Mum has been because we are women and we do things a little bit differently, and we know what feels good to us about customer service. So for me, I like things done quick. I like to know what's going on. I'm a control freak. You know, if I want a mortgage and I want mortgage advice, I want to know what's happening. Are you looking at that? And when am I going to get the figures back? And are you done yet? You know, I'm that customer. So I cater to those customers that I know it's quick, but they want it to be right. And they want to be able to ask loads of questions and WhatsApp questions and say, can you explain this to me? Or voice note and say, I just want to get my head around this because I want to understand it. You're not always going to get that level of depth of a relationship, whereas that is what we love. That's what we like doing. You know, there's more of us and a big community so that we can make sure we give that to every client. But in terms of advisors in general, the benefit is, like you said, a bank can only advise you on their products. The affordability between banks can vary by 100, 150,000, even more sometimes. So you could be...
That's a lot of money.
It's a lot. So what's happened recently is affordability is really changing.
Mm-hmm.
This is a really good example. I have a lender that I can access who only uses brokers. They will not let you go direct. They will give you 7 times your income, 7 times.
Mm-hmm.
Generally, high street banks are giving you 4.75 times your income, maybe 5.5 times. If it's nationwide, maybe 6 times even. But generally, they stick at around 4.5 times your income. And that was because of a rule from the FCA across all banks that said you can't lend more than 15% of your book to people with more than 4.5 times their income. And so banks would have to do a lot of, if you think about how much 85% is of a big high street bank, they would do a lot of 4.5 times income. But you've got these other banks that can give you 7 times. The FCA have recently said to all the banks, we think that might be a bit restrictive. So we're happy for you to give people more affordability in line with risk to make sure it's still safe. But we're happy for you to stretch that rule and ignore that 15%. And we're gonna come up with a new one, but we want to just see what happens. So now it's very personal. You've got, imagine it's just 10 humans in a row. Different people have different appetites. So you've got some banks going, brilliant, I'm going to stretch that. I'm going to give someone 6 times if they're a first time buyer. You've got other banks going, I'm just going to wait and see. You've got other banks that are like 7 times. We're going to go bold. We really want to help these people. And we know we feel safe because of X, Y, Z. You don't know that. We know because we've got relationships and the leaders are in the same rooms as these banks, and we're challenging the ones that aren't and we're asking the ones that are. You are not expected to know that. No Google search is going to give you that. No money saving expert search is going to give you the level of depth of what's going on in the market right now. And we are gearing the market up for you to get on the ladder. That's all anyone cares about, is trying to make this easier for people to get on the property ladder and trying to control the situation. So by going to any advisor, the Mortgage Mum or otherwise, we can look at every piece of information, every lender on the market, and we can search by their different criteria points to give you the mortgage that's tailor-made and bespoke for you. How you would do that on your own and get the exact right outcome, I'm not sure is possible anymore. Banks aren't all lined up. And I think that's the biggest thing for me, is things like this is amazing because we need to re-educate what it is to get on the ladder. You know, it's not save this, do this, get on. It's so different for everyone. It's very individual. So that's why, thankfully, our job is needed right now.
And Sarah, two things I want to pull out just in case someone is completely new to everything. But I know about this is news to me as well. I didn't know there was 7%, 7 times, a lender that gives 7 times. That's really cool. I've always worked on the 4.5%. So that's one example of why you need to do this, because I'm passionate about the space. Love it. I think I'm a mortgage geek. In fact, I should be a mortgage advisor.
I know, I'm like listening. You're a mortgage advisor.
But I mean, even I didn't know about the 7 times lender, for example.
No.
And there's this whole thing around being whole of market or someone that has restricted lending. How does the mortgage where does that mortgage mum sit on that ladder?
Yeah, so we are, they say that you're whole of market if you're with a network and that network gives you a pool of lenders that represents the market.
Okay.
I don't like the term too much because technically we are whole of market because we're with a network. However, when we do our searches, we can see all the lenders. So even if it says direct to bank only, it might say that it's off our panel. We can go to that lender and say, go to our network, and say, this product's best for our customer, even though it's not on our panel, and they'd let you do it. So where that whole of market is essentially giving you a bird's eye view of the market. It's pretty much all the lenders. There's still hundreds of lenders in the whole of market portfolio, but there will be some smaller building societies that sit outside, but we can see them. And again, you should be seeing the screen that we see, ideally, so that you can see and we can show you this is the best product on the market for you. If you see someone say they're an independent mortgage advisor, that normally means they don't have a network and they go directly to the FCA, in which case they can see everything. We can both see everything, but they don't have a panel. There's no kind of, it's all just fluid. They can just see the whole thing. There will be less companies that are under the FCA directly, but they are out there. So I personally wouldn't get too hung up on that. I would make sure that they're showing you and evidencing why they're giving you the advice you're giving. They shouldn't have any issues with showing their screen to you and showing you what they can see, if you are so inclined that you want to see it. Not everyone does. So they will normally just make it really easy for you, give you your top 3, for example. But there should be no issues. If you're someone that really focuses on that element, for example, let the advisor reassure you, because it's our job to give you the right advice. And as I say, the mortgage market is generally operated 90% by advisors. So there's not many products that we can't get.
That's so cool. And then last one, and we really should move on to another topic, but the 4.5 and 7 times, just briefly explain what that means for someone, because people must be wondering what's going on. So Sheila has asked, when you say 7 times, does that mean 7 times of my annual income for the whole mortgage, or what?
Yes, it does. It means 7 times your combined salary if there's more than one of you, or you on your own. So let me grab my calculator's here. Let's just say you earn £50,000 and it's just you on the mortgage. That's 7 times that is 350,000. It's not as straightforward as this, so please don't think you can just go onto a calculator. Did I say 350,000? Is that what I just said?
Yes.
Whereas 4.5 times is 225.
Okay.
So you imagine that is a big difference in the property that you can get depending on where you live. If you're anywhere near London, you need as much as you can get to get a decent sized property. So it can make a huge difference in terms of affordability. I think it's worth mentioning affordability calculators cannot be done on this. They have all sorts of things going on in the background, but it gives an idea as a headline as to what their affordability is like. We have really good tech that shows us this person has this random scenario. They have bonuses here, they get overtime there, they have their salary, but they also pay for childcare. They've got a little credit card balance. All of that has got to go into someone's calculator and give you the right result. And every lender will treat it all differently. So that's a good place to start, but please don't use that to determine your mortgage affordability. Get it done properly, is my advice.
Yeah, and I think, Sarah, another thing to touch on is I remember sometimes you can find out what your mortgage calculator is saying, or what your 7 times is, but it doesn't necessarily mean you should take out the full extent of that, because you still want to have a good lifestyle. And that I really, really agree that someone needs to go to a mortgage advisor. There's so many things you won't have thought about, even when you think you love the space. Like, I love the space, I breathe the space, I invest in property and everything, but even I don't know everything. So a mortgage advisor who's doing this every day is definitely the best place to start. You normally get some guidance free. In any case, they'll advise you, they'll tell you what's going on, and then you'll know. Oh, it doesn't mean that because you can get £350,000 of a mortgage, you should, because you need a car, you need to go on holiday. A big deal for me is going on holiday, right? And it just may not work for you. But yeah, I think let's go to the next topic, because I'm conscious that 20% of the.
Go on.
Sorry.
Go on. No, go on.
I was saying that I'm conscious that this is really cool, but I'm conscious that we have other types of people who are not first-time buyers.
Yes.
So let's go on to talking about homeowners, right? This is a really interesting one, and I already have some questions that came in.
Yeah,
so
sure.
Just give me a second. One of them is okay. Is this a good time for taking a mortgage or remortgage, or will rates drop? What is the market saying right now, and will things go from bad to worse after the November budget? That's a big one.
It's a really good question. So the November budget has a lot of anticipation around it, and hopefully we'll get onto portfolio investors, because particularly for landlords and the rumours around tax, there's a lot that we're wondering whether it's going to happen. Often nothing happens. There's a lot of rumours, and then there's very little sort of that actually comes to fruition at that time. And there's also talk of stamp duty being rewritten. So there's a lot around property and housing. And of course, Angela Rayner's recently resigned. So there's a lot of energy and talk around housing. What we're finding is a lot of people are doing what you've just said. Shall I just wait? Like, what's the situation? Taking politics out of it, which is very difficult because it does influence the market. The Bank of England base rate has obviously reduced a few times, as we know. It's sitting at 4% at the moment. And there's something called swap rates in the background that respond to the Bank of England base rate and inflation and market news. And they generally govern what the fixed rates are doing. So I take the time myself to look at what's happening in both of those markets and talk to economists. Now, this is a prediction. It's not fact. We have seen interest rates going up a little bit again because of the instability in the political space. You see the swap rates react a little bit, and the interest rates will follow. So I saw the swap rates go up last week and the week before, and I thought, I think fixed rates are going to go back up again. They didn't go back up dramatically, but they did go up a bit. They are going up a bit again. We are expecting the Bank of England to reduce the Bank of England base rate one more time. And the rumour is that it will be one and done. It won't be coming down anymore. It will stay at 3.75%. It's just whether it will happen this year or next. We believe that when that happens, because it will happen, it's just when, that the interest rates will stabilise. So they'll come down a little bit more from the slight increase we've just had, and they'll stabilise there. And that's really where we should expect rates to stick around. So we've got rates under 4%, in between 4 and 5%. We are not going to get them as low as they were at 1 to 2% again. So my advice to you is the remortgage market is generally there or thereabouts where it's going to be. I would say if you are looking at your rates, make sure that you have an advisor that price matches for you. So we have, again, tech in the background and systems, and we have our own internal systems where we will do you a remortgage now, but for the 6 months leading up to it, we'll rate check all the time to make sure if rates are coming down, because we're watching them so closely, we'll go into that rate and go, can we get you a better one now? Because the market's shifted. And if we can change your mortgage, even if you've got a mortgage offer, without any cost, and we just change it and get you a better deal. And we can do that all the way up to the day it transfers. Not everyone will do that. Not everyone has that tech. Not everyone has that time or energy or inclination to do it, because you don't get paid twice as a broker to do it. But we do, there are others who will as well. So just make sure that you say, if you're doing a remortgage, will you price match? Will you watch the rate market for me? And if it changes, will you automatically change it? It is worth doing that for anyone remortgaging now, because we are all waiting for the Bank of England to drop the rate, and I expect the fixed rates will go down a little bit then, but it's not going to be dramatic in my opinion. So I don't want you to get hung up on it. The most important thing is you do secure a rate in good time, that you are organised, that you don't drop onto the variable rate, which will be far higher than any fixed rate on the market right now, and that you're getting advice, because life happens, right? 6 months turns into 5, 4, 3, 2, and you don't want to have a messy, stressful exchange. What a lot of people then do is just stick with their bank, even if it's not cheaper, because they haven't got time to sort it out. We don't want that. We want you to look at what's the cheapest option, have a bit of a review, take the time. So hopefully that gives you a bit of perspective. It's a stable property market right now. It is stable. It doesn't feel it, but it is. Every data point we have shows us that it's stable.
That's very encouraging. Thank you for that response. Rauda is saying, thank you, Tina and Sarah, for this very insightful discussion. If I may ask, if I remortgage a property, how much would I be looking for? It isn't 100% of the property value. Or wait, is it 100% of the property value or 80%? P.S. The property company owned and purchased was on a bridging loan. Did you understand that? Do you want me to read it again?
So yeah, let's go through it again. So you've bought the property on a bridging loan, it sounds like, and you want to remortgage away from that bridging loan to repay the bridging loan back and mortgage your property. If that's correct, I'm going to give you time to reply.
Yeah. Rauda, if I've not represented it properly, please feel free to respond in the chat and it will come up to me. But yes, for now, that's what I'm understanding. I think she's responded. Okay. Just a second. Godwin, do you want to tell me what Rauda is saying? I can't see the chat.
I'll explain while you're waiting the scenario.
She says yes.
Mm-hmm. So when you got the bridging loan, and I know I don't want to talk in retrospect, but when you got the bridging loan, you would have had to have an exit plan. So you would have ideally had a remortgage agreed in principle, so that you knew what you were trying to do. So often, and I don't know what your situation is, feel free to elaborate, but people will get a bridging loan, for example, if a property isn't mortgageable, perhaps there was no working kitchen or bathroom, or perhaps it was a big renovation project or a property bought at auction, and you've bought it with a bridging loan, which is a short-term piece of finance for those who don't know. And then the idea is that you remortgage that bridging finance. Traditionally, although I said there are 100% mortgages out there, traditionally on a remortgage such as this, you would have a bit of deposit within that. So ideally, the value of your property has gone up. So let's just say, plucking situation out there and hoping it's close, you bought a property for 150, you've spent 100,000 on it, and now it's worth 350. So you would then get a mortgage for you could spend 250, so that would cover all your costs and your bridging loan on a value of a property at 350, and that equity would be sitting in as a deposit for that remortgage. And depending on how much percentage that is, depends on what rate we can offer you. That's a very simple calculation. Ideally, you've made money doing whatever you got that bridging finance for, because that's the idea of them, is they're higher cost, but it's because it's higher reward at the other end of it. You needed it quickly most people need the money quickly. So yeah, hopefully that helps. I don't know the full situation, but generally bridging finance, you would have had to have an exit plan, and it's important to get that ironed out. And if you haven't got that advice, to get it.
Thank you, Rauda. If that hasn't answered your question, you have any other comments, please let us know. But yes, I think that's a round thing. And I think, yeah, bridging loans are expensive. We took one out a few years ago on a property. We're trying to do a property investment, and gosh, I couldn't wait to get out of it. So we took it out for 6 months, and then after that, got a remortgage as usual. But the 6 months were hemorrhaging. It was so expensive. I
Yeah,
think it's meant
it's
to
a
be
last
temporary
resort for
finance.
people. Yeah. And like we always say, you would never walk on a bridge unless you could see the end of the bridge and how you're going to get off the bridge. And
Very
this
good
is the same with
philosophy.
any bridging loan. Like, don't get on a bridging loan unless you know how you're getting off it, because it will stack up quick. But it can work really well as part of a strategic plan.
Nice. Okay. So that's that question. There are so many questions. So
Okay.
apologies if we don't get through everything, everyone. I can see just the notifications of questions coming through. I can't see them. So if you have a question, don't worry, I'll get to it. But I'm waiting for the team basically to put them through to me. We have one that is we've already kind of touched on. We talked about the interest rate and if it's a good time. Sarah said it's a stable market, so do with that information as you please. But
Yeah.
my philosophy around it is that the best time to get on the property ladder is yesterday,
Yeah.
because in my opinion, even if the rates came down a certain amount, the house value is also going to be going up at the same time. So sometimes it's like the chicken and the egg, what are you chasing after? And my thing is get the property, secure it, and deal with rates at any point. You're going to remortgage in a few weeks anyway. It's fine. It's fine. Just get your toe wet. But saying that, I always say on all these master classes, I'm a very big risk taker. Thank
Yeah.
goodness I'm married to a very sensible accountant. Left to me, I would have nothing to my name because I take the biggest risks, right? So
I
you
love
probably
that
don't want
though.
to listen to me.
I love
But
that
that's
though,
my
and
take
I
on that
agree.
one.
Yeah.
And then Sheila is asking, is there any advice for buying a flat with a partner? Do we need a contract between each other if things go wrong? That's an
Oh,
interesting one.
that's a very interesting question. I would recommend it because we see a lot of good intentioned property purchases that then go the way that you don't intend it to. You can, this is more legal stance than mortgage, but there's a way of owning the property where if for example you were putting more deposit in, if you sell the property later on, you own a bigger portion of that property. But you can absolutely do agreements as well with your solicitor in terms of what would happen if. And I think having been through lots of different legal things in terms of my business, I think divorce and breakups and separation, whether you're married or not, if you have a property, it should be treated with as much seriousness because it's hard to get out of. And especially when there are children involved, people are very emotionally attached to their homes, and especially when their children are being raised there. And it will just mitigate kind of any future discomfort. So yes, I would recommend it. If you're asking the question, there must be some reason for you to ask it, and you should listen to that.
Totally, I agree. And it takes you by surprise. It's horrible, broken down communication, but it's better to be safe than sorry. I was Sarah, something interesting. I've always been very, very uncomfortable with things like prenuptial agreements, but the older I get, the more I understand the reasoning behind them. But at first I was just like, what the heck?
It's
That
like
means you don't love me, right?
Isn't it? Like, will you marry me? Yes, right. Let's talk money. Let's talk law. It's so sensible.
Yeah, but to be honest, it really makes it sadly it's a necessity. Some of these things are necessary, so I agree. Rauda is asking a follow-up question. She's saying, can she get cash on her property after the remortgage?
Yes. So you can do capital raising on a remortgage. Lots of people do it. I did it to renovate my house twice. So I did the loft once and then I did the downstairs. And I made money both times. So it's a really good idea. If you've got equity in your property, at every remortgage, I would encourage you to think about, do you want to release some of that equity if you've got a rate and you're happy to, you can afford to borrow more and you want to use that money for something else. And that might be investing in more property. It might be improving the property that you're currently in, or it might be another reason, sending your child to university, something else. Obviously, you're going to pay for that for the duration of your mortgage. So it needs to be thought through. But absolutely, you can release the money. So if you do make money on your property, which we have continued to do on our property here, although I think I've reached the limit now, sadly. But if you do make
you
money,
sound just as risk-taking as I am.
I am high risk. And then you can release that money and do an improvement, and then you go again. You know, the value's gone up again, and then you can do it again. So it can work brilliantly. I've done it myself, so I do know it's worked brilliantly, but it's not for everyone. And for some people, their primary concern is just paying that mortgage off. So to keep adding to the balance for some people is just absolutely not what they want to do. And there's merit to that also.
Okay, thank you. We are running out of time. There was a very good question. Sienna was asking that, are there any specific mortgage products designed for freelancers, self-employed individuals, or those with irregular income? There's many people in that situation, and they always feel like, oh my gosh, then I definitely would never get a facility. So that's a good question, Sienna.
It's a really good question. And yes, there are. They're not called self-employed mortgages. If you're a contractor, you do get contractor mortgages, people that look at your contract a certain way, and they will generally look at a day rate times 5 times 46. So they just assume that for some of the year you won't be contracting and you won't be working. If you are self-employed, it's just about how we measure your income. And the biggest tip I have for you if you're self-employed is, I think this is very unfair, and I'm always lobbying for self-employed, because when you're employed, I could get a job tomorrow, get paid 200 grand a year. I mean, I'm dreaming, but you know, let's just go with it. 200 grand a year, and that mortgage company will take that on an offer letter. Now, who's to say in 6 months' time I won't be working there anymore? Yet when you're a business owner, they don't really care what you brought in last month or the month, or even the last year. They want to see the last 2 years because they want to see stability, and they're going to average it. So if you, like me, have been part of a growing business, oh my goodness, it is so frustrating, because you've got to find a lender that will look at your latest year. And they're quite rare. They're getting better, but it's something we're constantly pushing them on, because we're saying the world is full of entrepreneurs now. The world is full of self-employed, and we need them to be looked at the same way as everyone else. So you absolutely can get a mortgage when you're self-employed, contracting a regular income. How we calculate it, that's our kind of calculation to sort out depending on the lender. But it can happen. It's just, you've got to leave it usually with us, and we kind of puzzle piece it together, and then we come back to you with the best solution. And often it involves calling lenders on your behalf and saying all about your business. This is their situation. Can we just use their latest year? Or even they look like they've just got a really big contract. Can we use what you think they're going to earn? And sometimes that is a yes, and sometimes it's a no. But we're seeing more encouraging signs for the self-employed, that people are looking at it more like a human and less like a robot, because you are growing businesses. So yeah, feel positive about it, but you've just got to be more organized. If you're looking to move in the next 2 years, don't write down things for your tax to be lower. You want your full income to be on paper so that you can borrow what you want to, and just know that if you are lowering your tax bill, you're lowering your mortgage affordability with it.
Cool. We've run out of time, so I'll let the poll is running now, the last poll, and it's what's your one takeaway from today? Just one takeaway. Thank you. I'm seeing so many thank yous coming through, so appreciate you. Thank you, everyone. But I'll ask Sarah one last question as you respond to the poll, and it's just give us one of your top property ownership tips or a trend as we wrap this up, and we let people fill out the poll of what they've found, what their one takeaway from our chat today has been.
Yeah, I would just say my top tip in life in general is find out information, get empowered, because the more you learn, the more you understand, the more empowered you are, the higher risks you can take, as you demonstrate. And you can only get there by asking the silly questions. We have ChatGPT now. If you don't feel comfortable to ask a human a silly question, you can ask the ChatGPT to give you a bit of a basis of understanding. Don't use it as advisors, but absolutely get your knowledge up by having those sort of conversations with the tech that we are getting more of. And try to be curious about it and learn, because once you own a property, you're going to have this mortgage and debt and this commitment for a very long time. It can give you so much joy, but it can give you stress if you don't understand how to manage what you're holding. So I would just say, be curious and try and get as much knowledge as you can in the process, rather than seeing it as a negative and a boring exercise.
Fab. Thank you so much. Mine would be get on the property ladder yesterday.
I love that quote. I'm so gonna quote that now. I loved that.
Yes, so thank you everyone for joining. It's been fantastic. I could chat to Sarah all day, as you have noticed. I wanted to show you, Sarah, that I'm also a journaling girl. I use the legend planners and that, so I totally resonate with that. But we are launching a book on the 1st of October. I'm doing a few library tours in Manchester, in Edinburgh, in London. So please go along, come along to one of them, and let's have fun and chat. It's been wonderful having you, Sarah. We've talked about it before this, that we may just jump on another one if we both manage to. So if anyone feels like your question wasn't answered, we apologize. There was so many of you that signed up, and that meant that there was so many questions we couldn't get through. We hope we've covered a broad range of topics. And again, the aim of this webinar, Girl Money Geek webinars and masterclasses, is to just be approachable and have conversations between people who you think are experts, but we're actually just moms and girls just trying to make the world a better place, just like you are. And so just trying to democratize education and information from experts. And I've been so